You failed with classical patterns, and you can't find out the reason? Classical patterns are considered interesting areas to execute trading opportunities. But do you know why some of the classical patterns work perfectly fine, while others get ignored by the market? To answer this question, we backtested more than 100 classical patterns under different conditions to find out the characteristics of high-quality classical patterns that are being respected by the market. We applied multiple rules to see if they really increase the win rate of classical patterns and gathered some of the most interesting results. We concluded that classical patterns work under certain conditions when some repetitive patterns happen in the market. In this session, we will reveal the secrets behind classical patterns, and also, we are going to show you how to avoid getting caught in wrong classical patterns. So, in this session of our free price action course, first, we will explain the basic rules in a simple setup for trading the classical patterns, and we will show you the backtesting results. Second, we will describe the conditions for high-probability classical patterns and how to increase the win rate of your trades. So guys, if that is something you are interested in, make sure to smash the like button to show your support and subscribe to our channel if you are new, since we publish many advanced trading concepts. See you after intro. Let's see what are channels. Channels are the routes that price takes in markets. Recognizing these routes may help to anticipate the price's next move. The good news is you are learning price action, and in price action, you won't need any indicator, and it is certain that by mastering price action, you will be needless of any indicator. The main point of learning channels in price action is to optimize your reward-to-risk ratio and enter any trading position professionally and minimize your loss. We will begin this session by talking about how to draw channels first. The fundamental parameter to check for drawing channels is pullback points in any trend. This means in bullish trends we should check higher lows and vice versa. In bearish trends we should check lower highs. If you have hard recognizing trends, we strongly suggest you check our previous session about trends. In the diagram shown here, there is a clear bullish trend. By connecting higher lows, it is possible to see a path that the price is respecting to it. This is another diagram where a bearish trend is visible. Again, by connecting lower highs, a trend line is formed. Now you can guess where the price may end up. Yep, you guessed it correctly. It is obvious that connecting lower lows gives a clear channel, but is it really necessary? The answer to this question is no. There is no necessity to draw an upper line in bullish channels and vice versa in bearish channels the lower line. However, by drawing these lines, it is easier to predict the range of price movement and closing point of the position earlier opened. Here are examples of channels in different charts. Pause the video and try to picture the channels in these charts. As it is shown, price usually reacts to channel lines. That is all you need to know about channels basic. Let's advance with classic patterns in price action. Over the years, trading progressed and developed, therefore as a result more repetitive channel patterns were recognized by traders. By understanding these repetitious channels and behaviors, traders have optimized their performance. As discussed in the session about candlesticks, there are also numerous classic patterns available on the internet. However, if you are not new with this channel, you know that the main goal of the Smart Money Atlas channel is to break old habits and optimize your knowledge in trading. Therefore, only the most crucial and important patterns here will be discussed. Before continuing, if you enjoyed this session so far, please do not forget to show your support by smashing the subscribe button. In this section, we're going to study one of the most straightforward continuation patterns that develop in the middle of a robust trading market. The flag price formation is similar to the wedge chart pattern, but the lines that encapsulate the flag structure don't converge, but the support and resistance levels are parallel. The second significant difference is that the flag pattern develops within a shorter period. A flag formation occurs when the market forms an area of congestion following a surge of activity. This indicates that both buyers and sellers are equally active at the current price. If the previous surge was upward, the breakout will usually be to the upside. However, if the flag extended far enough to break an uptrend line, then buyers will be wary because this is a sign that the momentum is waning. Many bulls will scalp out with a small profit on the breakout to the new swing high. Also, bears will look for another opportunity to sell at a slightly better price than the new high offers. This often leads to a reversal that may be either a scalping opportunity or the start of a protracted downswing. In either case, it is a low-risk, high-probability entry. The flag price structure unfolds in all markets, in all time frames, and above all, they show up on your chart a lot. Once you learn how to identify the bullish and bearish flags and understand their characteristics, it will become easier to trade them. In the first part of this session, we will focus on how to identify the bullish flag pattern in real time, and then move on to cover a straightforward trading strategy to capture the bullish trend. How to recognize the bullish flag pattern? The bullish flag pattern is formed by two distinctive elements. The first element of the flag pattern is a pre-existing trend. In the case of the bullish flag, we're talking about an uptrend. The second element is the flag attached to the pole, or in other words, the horizontal pause in the trend where the market moves in a very narrow trading range between a support and resistance level. The main characteristic of the flag is that the resistance and support levels are parallel. The most important part of the flag pattern is the prevailing trend, which is key to many chart pattern success rates. The easiest way to remember this rule is to remember that every flag has a pole. If the bullish flag pattern is something you want to incorporate into your trading, then you need to train your eyes to spot the shape. It looks something like the image shown here. Here is another example of a bearish trend. Again, we expect the trend to continue its bearish leg after the breakout from the flag. When trading the flag chart pattern, the level of volatility will decrease, and the price will compress until the prevailing trend is ready to resume again. You should view the flag price formation simply as a pause in the trend. You also need to be aware that flags tend to develop a lot quicker than other chart patterns, so you need to be able to act immediately. Otherwise, you risk losing the opportunity to catch the trend. The next step is how to enter, place your stop, and place the target for the rising wedge pattern. In final part of this session, we will show you how to build a trading setup using flag pattern. The next pattern here is discussed is the rectangular pattern. It is almost the same as the flag pattern with a minor difference that highs and lows are in a horizontal channel. Similarly, the expectation here is a continuation of the previous trend. It does not matter if the trend is downward or upward. In a rectangular pattern, there is a possibility of gaining small profits before a breakout. Because there is a trading range before breakout, the buy low sell high setup is active among traders. We talked about this setup in the previous session. Do not miss it. Finally, the last patterns to discuss are triangles and wedges. The traditional definition of a wedge is a converging triangle that slopes up or down, and traders expect the breakout to be in the opposite direction of the slope. They look for an upside breakout of a wedge that is sloped down and for a downside breakout of a wedge that is sloped up. Wedges are continuation patterns when they are pullbacks within trends, and they are reversal patterns when they are large and the context is right. When they are flags, they are small reversal patterns. For example, when there is a wedge pullback in a bull trend, the wedge is a small bear leg. Traders expect the bear leg to fail and to reverse up. In the broadest sense, a wedge is any pattern with 3, sometimes 4 or 5 pushes that is sloped up or down. It does not have to be convergent, and the third push does not have to exceed the second. As soon as there are 2 pushes, traders can draw a line connecting them, and then they can extend the line to the right and form a trend channel line. They will then watch for a reversal if the market approaches the line for a third time, identifying a wedge formation. While wedges are commonly known as continuation patterns, they are also known to signal trend reversals at major tops and bottoms. The reversal patterns are much larger than a typical continuation wedge and take significantly longer to form. So for the sake of all you short-term swing and day traders, we will focus on wedges as continuation patterns here. Wedges hold similar traits to both flag and symmetrical triangle patterns, in that they are drawn using 2 converging trend lines meeting at an apex. Price action will run counter to the prevailing trend, so a bullish wedge will slope down and a bearish wedge will slope up. You should see a noticeable drop in volume as price moves toward the apex, followed by a sharp increase once a breakout is confirmed. If price pulls back more than 50% of the prevailing trend move during the consolidation period, then the pattern is broken, and you should assume a change in trend is occurring. The closer any pattern is to the ideal, the more reliable it is because more computers will treat it as significant. However, traders should never lose sight of the underlying forces and should learn to become comfortable with every conceivable variation of every pattern. This will give them far more trading opportunities. There you go. These are the most important classical patterns you need to know. It is the treasure map, but let us move one step ahead and show you how to use this guideline to find the hidden gem. Finally, we will discuss trading setups that we backtested over a long period. But needless to say about any trading setup, please do your own backtest before implementing any strategy. Strategy to trade bullish flag patterns. The textbook strategy to trade the bullish flag pattern is to wait for a break and close above the resistance line. It's important to see the market breaking above the resistance line with strong momentum. Otherwise, the flag pattern may be part of a different and a larger price structure. For the take-profit strategy, we get to use part of the price structure of the flag, namely the pole or the prevailing trend. Only measure the price length of the pole and project the same price distance up from the breakout point. A visual image of the bullish flag and where to place the TP can be seen here. One of the main advantages of trading flag patterns is the opportunity to use a very tight stop loss. The protective stop loss placement is below the support line. You should also add a buffer to cancel out some of the short-term market noise. Let's now look through some real chart examples of the bullish and bearish flag patterns. How to trade a wedge setup. Confirmation of a breakout is made when a price bar closes above the upper trend line in a bullish wedge and below the bottom trend line in a bearish wedge. The way this pattern is set up, it is highly recommended to wait for a breakout before initiating a position. In a bullish continuation wedge, the two converging trend lines are pointing in the same direction, representing a series of lower highs and lower lows. So, playing the breakout makes the most sense, at least from a risk management perspective. Since you are entering the market near the bottom of the formation, your risk parameters are tight, while profit targets are exponentially expanded. Of course, more aggressive traders will still attempt to buy the lower trend line as the pattern progresses and use new lows as stops and re-entry levels. However, the conservative method of waiting for confirmation will most likely yield higher profits in the long run. The inverse is true when trading bearish wedge formations. Price will make a series of higher highs and higher lows as it moves towards the apex, and a position can be initiated when a breakout is confirmed with a price bar closing below the lower trend line. How to recognize false breakouts. A false breakout occurs when price moves above a resistance line or below a support line, and then quickly changes direction. These moves are known for trapping unsuspecting traders playing breakout levels on the wrong side, and then turning around to run their stops. More times than not, a false breakout will signal that the pattern you are charting has failed to produce the expected follow-through, and your expectations of the trade need to be re-evaluated. Identifying a false breakout can be tricky. That is why it is so important to maintain discipline when it comes to risk management. The single easiest way to determine whether or not a breakout is true or false is to watch the volume patterns. As stated above, when price moves toward the apex of the wedge, you should begin to see a noticeable drop in volume, followed by a sharp increase as price breaks out of the formation. The wedge formation is a low-risk, high-reward setup. Price and volume patterns need to align to confirm both the pattern and the breakout. If the formation takes too long to develop, or if price moves too far away from the starting point, you may be witnessing a change in trend. Congratulations, you made it to end of price action classical patterns session. From now on, you should be able to recognize these patterns and easily enjoy them in your trades. So, if you enjoyed this session, you know what to do. Until next time, take good care of yourself and your money.